Porter's Five Forces analysis shows that the threat of new entrants is low and there is a number of barriers making entry in the industry difficult. New entrants would have to invest a lot of time and money to establish new brands. What is more, they will have access to the cheapest and well-established suppliers. Competition in this industry is high with a steady trend. Profitability depends heavily on effective marketing and merchandising. Gap and A&F base their competitive strategies on different aspects. For Gap, price is the largest basis of competition, while A&F rely on style and product range when facing competitors. Because a number of brands have similar designs and an equal quality of product, the range available for the customer to choose from is wide, and for this reason the threat of substitute products and buyers' bargaining power are high. Examples may include independent retailers, boutiques, knockoffs on eBay or other cheap websites, and locally established chains as well as specialty stores. The fashion trade is extremely price sensitive and very mobile. Brands can move quickly to wherever they can find the cheapest pool of labour, which gives suppliers very little power. Because of the huge amount of fabric suppliers and high company profiles, both Gap and A&F are in good bargaining positions. From a macro-environmental point of view, Gap and A&F operate in the fashion and clothing industry. This pattern analysis helps break down the necessary areas businesses need to be aware of when operating. Firstly, political. Government initiatives. Businesses have to take into account the more general political ambitions of the government. For multinational corporations like the Gap and Abercrombie & Fitch, this would involve evaluating certain situations in different markets. From an economic point of view, consumer confidence. The economic downturn in 2008 dramatically affected the fashion industry due to the decrease in disposable income. However, recent research has shown that due to the recent growth in house prices, consumer confidence recorded a strong upward trend in 2013. Inflation and cost of resources. Consumer spending growth for clothing closely follows trends in inflation. Shoppers have consistently been willing to increase their spending even as prices increase. As you can see by looking at the purple line, the rate of inflation is severely affected by the cost of resources. Inflation of garments decreases sharply due to the rise in cotton inflation. From a social point of view, meeting consumer needs and following trends is important. Both Gap and Abercrombie have done this over the years by diversifying into new markets by creating sub-brands, such as Banana Republic and Hollister. Moral perceptions. With society changing and becoming more aware of the environment they live in, fashion companies have to be aware of consumers wanting ethically sourced clothes. From a technological standpoint, the internet plays a huge role within the clothing industry. Forrester forecasts that the US online retail sales will amount to $262 billion in 2003, an increase of 13% over 2012, and reach $370 billion by 2017. Furthermore, smartphones and tablets. Mintel's report Fashion Online UK in March 2012 highlights that speed and convenience prevail as the main advantages of shopping online. As the graph shows the increase in percentage change over the recent quarters, you can see that the clothing market are one of the leading users of internet-enabled devices. From a legal point of view, workers' rights and child labour. One of the main providers for clothing is Bangladesh. Even with the recent atrocities, including the Rana Plaza disaster, its exports are on track to rise by a fifth to $24 billion this fiscal year. This suggests that businesses are outsourcing their labour to cheaper countries in order to enjoy high net profits. The Institute for Global Labour and Human Rights have recently attacked Gap due to its perceived mistreatment of workers. The factory owners Harmeem Group, where Old Navy, a subsidiary of Gap, is produced, have been accused of not following the internationally recognised workers' rights standards. Environmentally, most stages of the production line have a negative effect on the environment, from industrial manufacturers polluting the air to dyes and prints harming the water system.
Competitor analysis benchmarking looks for patterns which will enable us to find two key dimensions. The benchmarking table shows 13 different competitors which both Gap and A&F cater for. This is compared with 6 different dimensions. This dimension helps to break down the competitors and show whether they have any strategic dissimilarity. The benchmarking table shows the price range of the product, quality, the size of the store, age demographic, and if the company operates on the global markets and provide home accessory. Strategic groups are organizations within an industry or sectors with similar strategic characteristics following similar strategy or competing on similar basis. Strategic groups above has been marked on 2 axes. These are price and quality because they are the most relevant when analyzing Gap and A&F. Looking at the strategic group that A&F and Gap are in, their main price and quality competitors are Levi, Jack Wills, Urban Outfitters, American Eagle Outfitters. This shows that they compete on the same basis and target the same age demographic. In conclusion, this ultimately means that Gap and A&F strategic groups compete heavily on price and quality. Furthermore, looking at the graph, there is a clear strategic gap for low quality and high price. However, due to this nature of market, an organization would not be able to survive providing expensive clothes at a low price.
After completing McKinsey 7S analysis, it can be said that both companies have different approach to their operations. Even though both companies concentrate on international expansion, A&F based their strategy on differentiation and customer in-store experience. Gap, on the other hand, does not put emphasis on delivering great experience for their customers and keep it simple. A&F have more layers of organizational structure than Gap, which allows their management to have a narrower span of control, therefore concentrating on managing different divisions and enabling quicker decision-making. Both companies invest in their employees in order to help them develop marketable skills such as management, financial planning, leadership, and others. But the cultural values are completely opposite. Gap promotes diversity, respect, and integrity, and treasure their staff by offering them various benefits. A&F is image obsessed and want only sexy and cool people to be part of their company so that they can attract more customers. Both Gap and A&F have corporate social responsibility integrated into their business model. Companies are focused on improving environment by enforcing energy and water conservation, reducing pollution, and recycling their waste. They support worldwide community engaged in charitable activities and help unprivileged citizens advance at work and in life. Both companies engage in initiatives to improve working conditions and ensure that human rights are being upheld within supply chain.
From a financial viewpoint, there are many interesting similarities and indeed differences in the statements shown. Firstly, the difference in their turnovers and gross profit figures. Gap, being the larger of the two companies, expectedly had the higher turnover of $16.19 billion, whereas A&F's revenue is $4.42 billion. What is interesting is a difference in their cost of sales. From a percentage point of view, Abercrombie's cost of sales are higher. We believe this may be due to the fact that A&F are more inclined to make sure their products are of a higher quality from responsible sources. Another interesting point is the amount of shares owned by insiders. Having a high number of shareholders employed by the business means that the employees have so much confidence in the direction of the business that they are willing to invest their own money into the organization. As you can see, nearly 40% of Gap's shareholders are insiders, whereas A&F only have 2%. Not only that, but 87% of all equities and portfolios perform better than Gap. Compared with the overall equity markets, risk-adjusted returns on investments in Gap are ranked over lower than 13% of all global equities and portfolios over the last 30 days. Whereas A&F has generated negative risk-adjusted returns, adding no value to the investors with long positions. Also, considering the 30-day investment horizon, Gap is expected to generate 0.67 times more return on investment than A&F. However, Gap is 1.48 times less risky than A&F. It trades about 0.24 of its potential returns per unit of risk. A&F is currently generating about 0.09% of its risk. SWOT analysis. Strengths for Gap and Abercrombie & Fitch. Gap has over 3,250 stores worldwide with over 140,000 employees worldwide. Gap has a section for baby products which are always in demand despite market fluctuations. A&F are present in about 300 locations in the whole of the United States and over 1,100 stores across 4 different brands including Hollister. They are a very large retailer of casual clothing and have many subsidiary brands that go along with it. A mutual weakness that they both have is intense competition in the apparel segment, which means limited market share and high brand switching. Some threats to both companies are rapid changing in fashion trends, rising production costs, putting dents in the profits of the brand, and brands replicating their styles along with counterfeits, as well as slowdown in spending on clothing. An opportunity for both brands would be online promotion and shopping on the brand, as well as expanding into unexplored global markets and creating a foothold.
Even though we have identified some similarities between Gap and A&F, ultimately it can be concluded that both companies have completely different visions and use different strategies to achieve their goals. The most recent performances show the more diverse targeting helped Gap secure solid earnings, whilst A&F has suffered a double percentage dip in their sales and decline in their stock prices. Gap's ability to keep up with changing fashion trends, successful international expansion, and development of online channels will most likely ensure a continuous steady growth in the future. Abercrombie's stock prices tend to fluctuate in tandem with their young consumers' tastes. Therefore, the company's future success would be dependent on their ability to adapt to a fast, changing retail environment, carefully manage expenses, and efficiently allocate its capital.